Hello, everyone. We are here to discuss on the ratios, which is an important aspect for any understanding of the financial statement or bank balance or anything, company performance, anything. Ratios are important, right? So let's understand about the ratio. Ratios. Why exactly ratios have been considered? Why not other parameters? Why ratios are important? We have to understand that first. If we understand that point first, why exactly we consider ratio? The reason behind it, ratio measures the relationship between two or more components. If you wanted to have a comparison between A and B, ratio is the important parameter where you can have a direct comparison or relationship. If how exactly A is performing, how exactly B is performing, how exactly A is worse performing or bad performing, everything can be measured more than one component. Okay, so that's where we use the ratios. Especially the ratios is the very good parameter where financial statements are being used. They are used most effectively when results over several periods. For example, how exactly this quarter is performing, how exactly last quarter, how exactly previous quarter, how exactly last year ratios. This performance, you can have a clear, okay, last year they have done 3% ratio. Before last year 4%, 3%, 2.5%. This ratio will give more clarity, okay, where exactly the company is weak or where exactly company has to perform. All these things can be measured in this. So that's why the comparison in terms of ratio several periods, it will be good. And third, ratio measures company's operational efficiency. How exactly operational efficiency or not, liquidity efficiency, stability, and profitability, giving investors more relevant and insight information than giving the raw data. Just take this as a, okay, this is a balance sheet, this is a PNL, this is the sales, this is the expense, this is the profit. All these things, if they give, they have to do it. Okay, how exactly they are performing, what is the percentage, their growth or degrowth. All these things, at the end of the day, the investors want it in a clean, clear, crisp. That clean, clear, crisp data can be given by ratios. That's the reason people will jump in to understand the ratios, and ratios play the major role in terms of financial decisions. That too, when the results are being announced for any companies, ratios are the utmost priority given understanding and in-depth analysis when we have taken any consideration. That's why we are here to understand that. So for your understanding, ratio means two component, right? For example, A and B. I am trying to compare A and B. How exactly A is working, how exactly B is working. Let's understand a simple meaning. A divided by B. Who is performing better? A is performing better, B is performing better. We'll have to identify mathematically, it is going to give you a fantastic results. For example, A divided B. Same thing here, it is like a numerator and denominator, right? See, this 1 is numerator, 2 is denominator. Okay, so for now, this denominator is fixed. Let's assume this denominator, that is 2, is fixed across all this. We are considering that only numerator is performing. Denominator is not performing only. Numerator means, for example, A is performing and B is not performing. When that case, when A is performing, always it is increasing from 0.5 to 0.1, 1.5 to 2.53. So meaning what? A is performed from 1 and they have increased to 2, and again they have increased to 3 now, and again they have increased to 4, again they have increased to 5, again they have increased to 6. That means A is continuously performing 1, 2, 3, 4, 5, 6 on every quarter. That is the reason the ratio is being increased. That is 0.5 to 1, 1.5 to 2.53, like that it is increasing. Imagine denominator starts increasing. Like instead of A being remains same, denominator starts increasing, like 2, 3, 4, 5, 6, 7, like this. Denominators are being increased means denominator will start performing. Numerators are not performing. That's why what exactly happens? 0.5 to 0.33, 0.25, 0.2, 0.16, 0.142. What is the meaning? Meaning denominator holds the strength than the numerator. Numerator is not performing here, whereas denominator is performing. So that's why the denominator holds the more strength than the numerator. Always remember, this is simple mathematics. Numerator and denominator. Whenever numerator performing, market will go up. Whenever denominator performing, market will go down. It's a simple understanding. Market will go down means the B is performing, A is not performing. Simple meaning. Don't think that market is going down means, oh, it's crashed. No, it's not like that. It is a numerator is performing and denominator is performing. Simple math. Now, let's take a real-time example, how exactly it works. Let's take an example of Infosys and Wipro, which is a real-time example. How exactly Info is working or Info is performing against Wipro, because both are technically on IT stocks. That's why we have taken this as a comparison. We are trying to find out the relationship between and performance, all this analysis we are trying to do. We'll be considering A as Infosys and B as Wipro. If A value starts increasing, Infosys starts performing, meaning if A value is going up, Infosys is performing. If B value started increasing, that means Wipro is performing. So if B value is increasing, Wipro is performing. If A value is increasing, Infosys is performing. Simple. When numerator is increasing, Infosys is performing. When denominator is increasing, Wipro is performing. Just make this as a simple understanding. Always think like this, numerator and denominator, so that you will not get confused. If Infosys is performing means numerator is working very well. If Wipro is working, that means Wipro is working very well in terms of denominator. That's all. Simple ratio. Now, let's understand important ratios so that you will understand even much better knowledge about it. Hope you are clear on this slide. One example on the ratios. Financial terminal, that is A over B. A is nothing but debit. B is nothing but equity. If A increases, means what? Debit is increasing. If B increases, what? Equity share is increasing. So that means if A is increasing, that means debits are increasing. Equity remains same. That means the company is in the more loan or more debits is taking, or more debts at that level. If it is started increasing and debit remains same, that means what? The company is able to perform better than the debit. That means they have a lesser loan and their equities are working much better. So like that, the debit and equity also will be analyzed. Always remember, if debits are increasing, that means equity remains same, means the company is under the more loans getting into that. If equity is increasing and debit is decreasing, that means the equity is growing much better and company is reduced at the debit equity. So that is how we call it as a debit to equity ratio. All simple understanding, numerator and denominator. If numerator is increasing, that means company is under more debits. If denominator is increasing, that means company is having more strength on the equity. Simple logic. Numerator and denominator. Right from mathematics, and then example of real-time stock performance, and example of this ratio, company financial status, that is whether company is under debt or equity. Like this, you can understand. So this is the example. If still not clear, just let us know. We can make it even more clear understanding logic. Now, first understanding is EPS, earning per share. What is EPS? EPS can be defined as the value of earnings per outstanding share. That means EPS is like how much per share can be earned. How much share? That means earnings per share, per outstanding share of a common stock. So this should be in the range of 1 to 99, with 99 being the best. And this should be referred from the balance sheet plus P&L statement. This will be coming from the balance sheet and as well as P&L statement. In the below, I have given the example as well. So the simple formula is PAT minus dividend divided by number of outstanding shares. How much earnings are happening per share, per shareholding person is what we are trying to identify. For example, if I am holding 10 shares, how much is the value of shares I'm going to earn additionally? Like last year was 100 and this year is going to be 110 or 120. Like that, how much I'm going to earn? That is called earnings per share. The formula is PAT, that is profit after tax. There is no depreciation, there is no interest, there is no other expense, nothing. It is clean take home. In your simple term, it's a take home net salary. Net salary is nothing but PAT, profit after tax. Nothing is deducted. It is like if you are getting 100 rupees, that means 100 rupees will come to your company account. Like that, it is PAT. There is no other deduction. It is net amount minus dividend payouts. Dividend, every year the company will be issuing the dividends. From their profit only they have to issue. They cannot issue the dividend from the sales. They have to issue the dividend from the profits, because sales has got the expense as well, has got the tax as well, has got the depreciation as well, has got the interest as well. So that's why they cannot pay directly whatever the sales is happening, that much amount they cannot pay out. They have to pay out from the profits only. That is net profit minus dividend divided by number of outstanding shares. For example, here, let's take an example. We have put, this is a X company balance sheet. The net profit, we have not, this is sales is happening, expenses and operating profit and other income, interest, depreciation, everything is excluded. That means 33,322 was the previous, and actual take home is 24,108 crore is what called PAT, profit after tax. Dividend payout is 58%. 58% dividend payout means how much? 24,108 into 58%, which comes to 13,982 crore. So 24,108 minus 13,982, that is 10,126 will be your PAT minus dividend. After paying out the dividend, you are left out with 10,126 crore divided by total shares, total outstanding shareholders, how much we are having. This is been captured from BSE India website. If you go to corporate actions, you will get this information. So number of fully paid up capital, that is 4,14,000. This 10,126 divided by this shareholding, outstanding shareholding, you will get the EPS value. This is called earning per share. So this ratio should be the best, that is 1 to 99, and 99 being the best. So always EPS should be 99 for being the best, and it starts from 1. Okay, and it has to be referred from the balance sheet. Balance sheet, you will get the outstanding share details, and if you go to BSE India website, you will get the shareholders number as well, so that you can have a clarity on the EPS details. So this is how this EPS have been generated here. Simple logic, PAT minus dividend divided by outstanding share, that comes to EPS is 58.08 rupees. Simple. Hope you are clear on this EPS. This is the earning per share calculation. Now let's go to the second one, debt to equity. Debt to equity is total debit divided by total shareholders equity. Debt to equity means what? Company how much loans against the equity or against the asset they're having. So debit means what? Liability, whatever goes out. Okay, so total assets minus liability. We are having both the calculation here. Let's understand before that what is debt to equity. It shows the company's ability to pay debts with its equity. So it is showing that whether company is able to pay the debits. Say suppose if company is performing 100 crores, out of 100 crores, if debits is 90 crore and equity share is what? 10 crore, then that means company is having more debit. If the debit is 10 crore and equity share is 90 crore, that means company is overperforming. The shareholders equity is more. Simple, right? So it shows the company's ability to pay debts. A good debt to equity ratio of around 2 to 2.5 is generally considered as a good one. Okay. So now let's have simple calculation for more insight understanding. Total debt, that is liabilities. Sorry. So what is total debt? That is whatever is going out, borrowings, other liabilities. So sometimes we calculate borrowings, sometimes we don't calculate borrowings, but other liabilities for sure, because it has to go out. This borrowings is 8299 is going to be come to your investment because you must have taken the loan to invest for something. But anyway, this 8299 is actually your borrowings. So that also you can consider it as a liabilities. Borrowings plus liability, that is 8299, 40,890. 8299 plus 40,890, which is equal to 49,189, which is the total debit so far, right? Divided by what is the total shareholders? Total shareholders equity formula is total assets. Total assets minus total debit. So total asset, for example, if you are having 100 crore assets, that something has to be payable like trade receivables, trade payables, whatever XYZ. So that's why we are deducting that liabilities. So we have got total debt, that is what 49,119, 189, and total assets what 1,24,596. So 1,24,596, which is equivalent to 75,409. So now I got 75,409. So simple 49,189 divided by 49,189 is total debit. 75,409 is total shareholder equity, which comes to 0.65. So this is called debt to equity ratio. So this should be around 2 to 2.5. So that means what? Shareholders equity is more, 75,409. Whereas the liability is lesser. So that means shareholders equity is performing. Liability, debit is being taken care of, right? This is how we are going to find out the debt to equity. Hope you are clear on this debt to equity. Now this debt to equity we will be using for other parameters, which is an important parameter, which is an important parameter will be looked at by investors. Okay. ROE, return on equity. You must be thinking return on equity is more or less same as earning per share. But what is the difference here? Earnings per share and return on equity, because earnings per share, just pull it down for a better understanding. Earnings per share is PAT minus dividend. That is profit after tax minus dividend divided by outstanding shares is called EPS, right? So this is EPS is PAT minus dividend divided by total number of outstanding shares. Here what exactly we are looking for? Shareholders equity itself. Shareholders equity, how exactly it is being calculated? Shareholders equity is, we just calculated in the previous slide. Shareholders equity, total shareholders equity is nothing but total assets minus total debits. We will get insight of this. In earnings per share, we will get only PAT, direct PAT minus dividend divided by total number of outstanding shares. How much earning per share is happening to the shareholders we are getting. Here in return on equity, you should understand when an investor invests, necessarily expect a return on what has been invested. For example, if investor is investing 100 rupees, he is interested in understanding where is that 100 rupees being invested. Whether is it being invested on the purpose of asset, or is it being invested on the purpose of paying loans or debits or whatever. So they are very much interested whether where exactly my investment is earning. And this ratio describes how well the company is able to restore what have been invested. So this will give you the insight. Say suppose if investor is paying 100 rupees, whether is it being invested in the right way or wrong way, or they are investing in the intelligently or wrong. Every information will be provided in ROE. So EPS you will not get much insight information, whereas ROE you will get detailed information, detailed insight of this investment. That's why investors are interested in understanding ROE than the EPS. Though EPS is growing, is good company, but still if ROE is growing, that's a good, much better company. Okay. So higher the ROE will increasingly attract investors and lead to a rise in a stock price. If ROE is rising, definitely investors are interested and they will bring back more investors and the stock price also will go up. So ROE is the important parameter. So here ROE, there are two types of formulas. That is, one is simple formula, that is PAT minus dividend by shareholders equity. And the other one is dew point formula, DUOPONT point formula. So that we will discuss in the next video. So this we are understanding ROE, PAT minus dividend. PAT minus dividend we have already done with our example in the previous in earnings per share. So that only you can refer. Second, I've just put it for your reference, 10126, PAT minus dividend. Total shareholders equity equals to total assets minus total debt. Total assets is what? 1,24,000 minus total debt. This is what total debt, that is whatever is there in the debt level, that's it's going out or payable. So which is come to 75,409. PAT minus dividend, that is 10126 divided by 75,409, you will get ROE. This is called return on equity. So this return on equity, why exactly this is attracting investors? Because investors, people have taken this loan or whatever the investment, where are they putting? Are they keeping this as a reserves, or are they keeping on assets, or are they keeping on investments? Are they keeping on a new buyers or whatever? So they are interested in understanding all this asset formula. So this assets is going to be directly related. So that's the reason if ROE is increasing, that means it will attract the company. Company means it will attract the investors to invest on such companies. That's why ROE is important. So because of this, ROE is being elaborated with the dew point formula. This will be continued in the next video. The dew point formula is going to give you insight of this ROE, meaning like how the PAT and as well as the asset ratio and leverage ratio, all these things will be considered so that you will have an insight information. That's why we made the video to be breaks instead of making it a longer video. So we just made it at shorter. So hope this is understandable. So if any doubts or clarity, please let us know. Thank you so much for spending time. So please like and comment and share us.